How banks really make money. Have you ever wondered what banks actually do with your money? We deposit our savings into banks, and in return, banks pay us interest. But if banks are giving us money, then how are they making money? Today, let's break down the business model of banks in the simplest way possible. The core business of a bank. Many people imagine banks storing money inside giant vaults, protected by heavy locks and security guards. That may look good in movies, but that's not how banking works in real life. Banks don't simply store your money, they use it. The money you deposit is used to give loans to other people, and this is where banks make their profit. A simple example. Imagine you deposit 100 into a bank. The bank pays you 4% annual interest. So after 1 year, your 100 becomes 104. Now the bank takes that same 100 and lends it to someone else, maybe for a home loan. But this time, the bank charges 8% interest. So the borrower returns 108 to the bank. Out of that, 104 goes back to you, and the remaining 4 becomes the bank's profit. This difference between the interest earned and interest paid is the foundation of banking. But here's the big question. What happens if you suddenly want your 100 back, while the bank has already given that money as a loan? Or worse, what if the borrower never repays the loan? That creates a serious problem, because banks never keep all deposited money sitting idle. Most of it is loaned out. How banks stay safe. To prevent banks from collapsing, central banks create rules. In India, the Reserve Bank of India, RBI requires banks to keep a portion of deposits as reserves. 1. Cash Reserve Ratio, CRR. Banks must keep a percentage of deposits in cash. 2. Statutory Liquidity Ratio, S. Banks must also invest a portion in safe assets like government bonds, gold, approved securities. These rules ensure banks always have some backup money available. But even after maintaining reserves, banks still lend out most of the remaining money to earn profits. What is a bank run? Now imagine something dangerous. Suppose everyone rushes to the bank at the same time and demands all their money back. No bank in the world can survive that, because banks simply do not keep 100% of deposits in cash. This situation is called a bank run. Usually, it only happens when panic spreads among people. The real risk: bad loans. The bigger danger for banks is not withdrawals. It's bad loans! When borrowers fail to repay large amounts of money, those loans become NPAs, non-performing assets. Too many bad loans can push a bank into crisis. This is why banks carefully evaluate whom they lend money to. How banks earn in low-interest countries. In countries like Germany, loan interest rates can be extremely low, sometimes close to 1%. So how do banks make money there? Simple. They also reduce the interest paid on savings accounts. In many European countries, savings accounts offer almost zero interest, and banks charge monthly account maintenance fees. So customers actually pay banks for banking services. Other sources of bank income. Banks don't rely only on loans. They also earn through fees and charges. ATM fees, account maintenance fees, service charges, penalties, investments. Banks invest money into government bonds, gold, stock markets, other financial assets. These investments generate additional profits. Biggest expense of banks. One major expense for banks is employee salaries and operations. A large portion of bank expenses goes toward staff salaries, branch operations, technology, and infrastructure. SBI versus HDFCA. Real example. Let's compare two major Indian banks. SBI, India's largest public sector bank. HDFC Bank, India's largest private bank. SBI has more customers, larger market share, and larger reach. Yet HDFC's market valuation is significantly higher. Why? Because private banks have greater flexibility in investments and business decisions. Important banking metrics. Net interest income. The difference between interest earned and interest paid. Nets, interest margin, NIM measures how profitable a bank is from lending activities. Higher NIM usually means higher profitability. Gross NPA ratio shows how many loans have turned bad. Lower NPA equals healthier bank. Final thoughts. At its core, banking is a simple business. Take deposits, lend money, earn from the difference in interest. But behind this simple idea lies a massive financial system built on trust, regulation, and risk management. Banks survive only as long as people trust them. And that trust is what keeps the entire economy running.